Welcome back. Today we take 3 words people throw around as if they mean the same thing: investing, trading, and gambling. And we separate them for good. 1 buy button, 3 completely different games. The difference is real, and it is not where most people look. Let me show you.
Now, hear me out. Trading is just gambling with extra steps. You pick a thing, you put money on it, you hope it goes up. A nicer screen does not make it not a casino. Change my mind.
Fair challenge, and most of the time you would be right. The extra steps are usually just decoration. But watch the button. Same finger, same click. It just cast 3 different shadows. One of those is gambling, one is trading, one is investing. The click did not decide which. Let me show you the thing behind it that did. In about 10 minutes, you will be able to look at any buy order and ask 2 things. Where does the expected return actually come from? And was the way out decided before the click? Not the coin, not the chart, not how serious the person looks. Those 2 questions.
Okay, but my point stands, right? Hold on. Are you about to tell me this is all just gambling with extra steps? So the boring index fund is the only safe move? Because a roulette player picks red, spins, and hopes. A trader picks a coin, clicks buy, and hopes. Both are guessing about a thing they cannot control. Where is the actual difference, other than the trader owns a nicer chair?
That is the strongest version of the argument, and it deserves real credit, because for most people who call themselves traders, it is exactly true. If all you have is a click and a hope, you are at the wheel. The serious-looking screen changes nothing. Kevin Davey, who tests systems for a living, puts it bluntly. A pattern existing on a chart is not a trade, and trading a handful of times by hand is not a process. Looking like a trader is not being one. So far, it sounds like I am just agreeing with you that it is all gambling. I am not. I am agreeing it is gambling until one specific thing is true. The roulette player and the unedged trader are the same. But there is a third person who is still uncertain, but not purely guessing. They have a measured process whose average outcome has historically cleared costs, and a fourth who is not even at the wheel. The difference between all 4 is not the click, it is a number. Let me build it. Here is the test, and I want you to actually commit, not just watch. One person places this exact buy order. Same order, same coin, same second. Pause right here and call it investing, trading, or gambling. Pick one, out loud or tap it on the screen.
Wait, that is not fair. You have not told me anything about them. It is the same order either way.
That is the whole lesson, and you just walked straight into it. You cannot tell from the order. Nobody can. Hold your vote. By the end, you will know exactly what you needed to ask before you could answer, and it is never which coin. Before I build that number, meet the man who proved it exists. 1961. Ed Thorp is a young mathematics instructor at MIT, and he is quietly obsessed with a question every respectable adult considers settled. Can the casino be beaten? Everyone knows it cannot. The house always wins. That is what a house is. But Thorp does not treat "everyone knows" as evidence. He puts blackjack through an IBM mainframe, one of the first people to point a computer at a card game, and finds something the casinos themselves had missed. Cards leave the deck as they are dealt, so the odds drift as the deck thins. A player who tracks what is gone can tell when the edge tips, briefly, to the player's side. Not a feeling, not a lucky system, a computed, written down, positive number. He publishes it, raises a bankroll from 2 wealthy gamblers, walks into the casinos of Nevada, and wins. On one reported weekend, roughly $10,000 became about $21,000. Then he writes it all up in a book, Beat the Dealer, and it becomes a bestseller.
Wait, and the casinos just let that happen?
They did the most honest thing a business can do. They changed the rules. More decks, earlier shuffles, and by Thorp's own account, he was quietly barred from table after table. That is the cleanest certificate an edge ever gets. The house redesigning the game to make his number stop being positive. Then Thorp looks at Wall Street and sees the same shape. Repeated bets, uncertain outcomes, prices that are sometimes slightly wrong. So he walks the identical discipline into markets, mispriced options now instead of thinning decks, and runs one of the first quantitative funds. Its reported track record became famous less for its size than for its steadiness. roughly 2 decades, reportedly without a single losing year. Not because he could see the future, because before every bet, at the felt or on the exchange, there was a written, measured, positive number, plus a rule for the size of the bet and a rule for the way out. Same cards as everyone else, same buy button as everyone else, a different number behind the click. That number is what we are building next. What separates the third person at the wheel from the gambler is one thing they can write down. We call it an edge, and an edge is not a feeling. It is a number, and the number has to come out positive. Let me grow it in front of you. Start with what you win. How often you are right, times how much you make when you are right. That is the first piece. Now subtract what you lose. How often you are wrong, times how much it costs you when you are wrong. We measure the wins and losses in R units, where 1 R is the amount you risked on the trade, so everything stays in the same currency. What is left is your raw expectation, your expected value per trade. And then the part almost everyone forgets, and the part this whole module keeps hammering. Subtract the costs. Every click pays a spread, a fee, a little slippage. So the edge is not, do I win more than I lose? It is, do I win more than I lose after the house takes its cut? If that final number is positive, you have an edge. If it is 0 or negative, you do not, no matter how confident you feel.
Okay, but you could just claim a positive number. How is that different from the gambler telling himself he has a system?
The best question yet, and the answer is the line between trading and gambling. The number has to be supported by evidence, measured out of sample, after costs, across enough trades that luck is not the obvious explanation. Not asserted, not felt, not it worked to last 3 times. Let us actually compute one. Same formula both times. The first setup wins less than half the time and still has a positive edge because its wins are bigger than its losses, even after costs, plus 0.3 R per trade. In this toy setup, repeated over enough independent trials and assuming the inputs are real, the average point's positive. In real trading, proving those inputs is the hard part. The second setup is a coin flip, 50-50, even money. Looks harmless, subtract the costs, and it is minus 0.05 R per trade. Click that one 1,000 times and you bleed, slowly, with perfect confidence. Nothing about the click changed, only the number behind it. Now the part that turns even a positive edge click into gambling. And this is Davey again, almost word for word. Without goals and objectives established up front, he says, it is just gambling. So here is the second question, and it is brutal. When did you decide how this trade ends?
When it ends? When I sell, I guess, when it feels right.
When it feels right. That is the sentence. The investor has a multi-year thesis, diversification logic, risk budget, and pre-decided review rule. They are not claiming the next candle is theirs to predict. The trader decided before the click. Here is my exit or review rule. Here is the rule that takes me out, win or lose. The gambler decides after the click, in the moment, with his pulse in his ears. Same entry, totally different animal because of a decision made before the finger ever moved. So a real trade has its exit written down before it starts. The plan is not the part you do at the end. It is the part you do at the beginning, when you are calm, and then obey when you are not. Take away the evidenced edge, or take away the pre-decided exit, and whatever is left is a slot machine. A nice chair does not save it. Let us put real markets on this. Same buy order, 3 different people, and watch where each one lands on the axis. Left of 0 is negative expectation, right of 0 is positive. Crypto first. Person 1 buys a broad basket and intends to hold for years on a thesis about long-run adoption, with a rule for what would change their mind. Broad holdings, a thesis that spans years, and a review rule, that is, investing by process. Whether its expected return is positive is a separate evidence question. Worked on its own terms, it is the one here that does not depend on out-trading anybody. Person 2 places the identical buy as one trade inside a back-tested costed system, with the edge measured out of sample and the exit preset. That is trading. It can sit right of 0, but only just, and only if that edge survived honest testing after costs. Most do not. In our own research, across thousands of out-of-sample tests, almost nothing cleared the bar after costs, and we will show you those receipts in Module 7. So this one can work, and usually broke. The edge people swear they have mostly evaporates the moment you subtract the house's cut and test it on data it has not seen. Person 3 saw a stranger post a rocket emoji and aped the same coin. Same click, no edge, no plan, no idea how they would get out. That is gambling, and it sits left of 0 because after costs, an unedged click has negative expectation, exactly like the roulette wheel. Broke, structurally negative on average, even though any single click can still win. The equity version is the same story with the instrument swapped. An index fund hold is the investor, the same share traded inside a tested, costed system is the trader, and a meme stock punt off a viral post is the gambler. The axis does not care what you bought. So the why is the thing nobody wants to hear. It was never about the coin, and it was never about the click. 3 identical orders landed in 3 different places on one axis, and the only things that moved them were an evidence-supported edge after costs and an exit decided up front. Roulette is honest about being left of 0. Most trading is gambling that has not done the subtraction yet. Lock it in. Forget the coin, forget the chart. The order alone does not tell you which of the 3 it is. What do you need to ask?
So the order itself is not enough. I need to know whether there was evidence, costs, and an exit rule.
Exactly. The clean test is, what is the source of expected return, and could they support it before they needed it? Call it the plan test. Can you name your edge and your exit before you click? If you cannot, you are not trading or investing. You are gambling. One question for you, and it is not a throwaway. It is a test of whether today actually landed. A friend shows you a 50-50 setup. Even money. Wins half the time for 1 unit, loses half the time for 1 unit. He says it is a coin flip, so it is harmless, break even. No harm in clicking it 1,000 times. Using today's edge formula, tell him exactly why he is wrong, and say what single thing turns his harmless coin flip into a slow, confident loss. There is a second question waiting in the pinned comment if you want to push further. Take a past trade, a paper trade, or a hypothetical example, and run it through today's test. Not as a decision rule for any live position, just to classify it. And for everyone who keeps a calculator within reach, here is a second one with actual numbers. A system wins 40% of the time. The average win is 1.8 R. The average loss is 1 R. Costs come to 0.08 R per trade. 2 parts. First, compute the edge in R per trade. Second, and this is the real question, find the win rate where this exact system crosses 0. And notice how close that is to 40. Post both numbers and one line on what that gap tells you. Post your answer in the comments. We read them, pin the sharpest ones, and walk through the full model answer in the pinned thread. And to be clear what that is, we show you how to run the test, how to find the edge question and the exit question for yourself, never whether to make the trade or close it. We teach the thinking. The decision is always yours. Cards on the table, Leo. Here is your mind changed and not changed at once. You were right. Most trading really is gambling with extra steps, and the steps really are just decoration. Until 2 things are true. An edge you can support with evidence after costs, and an exit you decided before you clicked. Have both, it is trading. Have a diversified multi-year thesis instead, it is investing. Have neither, it is a casino with a candlestick chart. The click is identical, the edge is not. Next time, the uncomfortable math underneath all of this. Why, after costs, the average click is not even a coin flip, it is a slow loss. And where exactly the money goes. 1 button, 3 games, and the market will never tell you which one you are playing. That part is your job, and you do it before you touch the button, not after. Build that one habit, and most of the danger in trading quietly goes away. Subscribe, and I will see you next time.